Hey everyone, so I'm here today with Kyle Pugel from Guaranteed Rate Affinity, and we wanted to discuss something in a little bit more detail because we did this video on a buy down, a rate buy down, something that would be an option for a buyer when making an offer, and there were a lot of questions that the public had about that, and it drew actually, quite a bit of views and quite a bit of questions and even some misunderstandings that hopefully today we can clarify.
Yeah.
So the first thing, and I think, I just kind of went through the list of all the questions that came across this video in the comment section. And the first one was, is this an adjustable rate mortgage? Or maybe before we even go there, maybe explain what it was we were talking about with that product and what's available to someone.
Right. So it's interesting because we did get a lot of comments.
Right.
And the nice part about getting the comments is we live in this business every day. And so for us, it's second nature. We don't even think about it. And putting us out there and presenting this really opened up my eyes to the misconceptions that the general public have about mortgages and products that are available and skepticism about going back to 2008, right?
Right.
So first of all, it was about a temporary buy down, which doesn't actually change the rate of the mortgage. It's a 30-year fixed mortgage. Mm-hmm. But what you're doing, it's just an alternative way to use seller credits. Because in this market, we're seeing more and more sellers willing to offer credit or price reductions. So if you take advantage of those seller credits, you have a multitude of options as a buyer on how you want to utilize those for yourself, right? That makes the most sense for your situation.
You can apply it to a number of different things that are important to you.
Right. And a temporary buy down is something that was popular back in the 70s and 80s and then went away. And then in the last 15 years, we've been in an ultra low interest rate environment. So there's been no need for a temporary buy down. Right. Now that interest rates are going up, temporary buy downs have come back as an option to help people with their payment versus just doing your one-time out-of-pocket at closing. So what it actually does, it takes your fixed rate mortgage, mm-hmm. and then depending on the temporary buy down option you have, it's going to lower your payment, your out-of-pocket expense for, in our situation, we did a 2-year buy down. So in the first year, it's going to be your payment's going to be the equivalent of 2 percentage points less than your locked rate. In the second year, it's going to be 1 percentage rate less, and then you're going to be responsible for your full payment starting in year 3 through year 30.
Right.
And that extra money is coming from the seller credit. So every month, that money's held in a separate account, and basically the seller's just going to pay a portion of your payment in years 1 and year 2 on an escalating scale.
So it's paying for a portion of that interest payment, if you will?
Yep.
Does it change the amount that's applied towards principal in that payment at all, or no?
It does not.
Okay. So they're still reducing the principal amount of the loan.
So it's a 30-year loan, 30-year amortization. Your regular payments are being made on time. It's just you're splitting that cost with the seller.
Okay, awesome. So one of the questions were, is this an adjustable rate product? Right. So I think the concern is that, with the adjustable rate products is that somebody only has to qualify for that lower payment. And then come year 3, they run into a situation where if they couldn't refinance or the rates didn't drop as many people are predicting that they will, that they'll be stuck in this really bad situation where they can't afford to make those payments. So, so this is a fixed rate loan, and year 3, what happens? It goes to the payment?
Nothing changes. The only thing that changes is you're out of the seller funds, so now you're just making the whole payment.
Got it.
But your overall mortgage payment doesn't change. Your interest rate does not change. In fact, the disclosures you sign at closing mm-hmm. are with that fixed interest rate with the full payment.
Okay.
So there's no surprises in year 3. I mean, you just
and
someone else just isn't helping.
And the borrower is being approved based on that full payment, not the lower payment.
Absolutely.
Okay, I think that's an important thing for people to understand is that this isn't something that somebody's going to find themselves in trouble with in 3 years. Clearly, they'll have the benefit in the first 2 years of having a lower payment, and I don't know that there'd be payment shock necessarily because they're aware that this is coming and they have to kind of adjust for that when it happens. But I think that might be some of the concerns too is the payment shock. Sure. But so if we look at the actual dollars and cents of it, I know we were talking about an offer of $600 versus $615 with $15,000 in seller credits. So in the first year, the second year, how much would a buyer be saving on their monthly payment? What does that equate to? And how much of a difference would it be from their first payment until like year 3 when their payments adjust to the full payment? What does that look like?
So, okay. In this scenario, we had $15,000 in seller concessions. Now, we used a 2-1 buy down as an example. Mm-hmm. 2-1 buy down right now is actually going to cost you about 2.2% from the seller. So that's a little bit less than the $15,000. It's actually like 12.3-ish. So that's the amount that's going to be held in a separate account that's going to be applied toward monthly payments. Okay. That additional 1,300 or what is it? 1,400 right. is just going to be applied towards normal closing costs.
Okay. So like you don't have like the numbers though, like how much it would cost somebody. Like what is their monthly payment going to be? I know it's variable depending on how much they put down and right. I know you had an example.
Yeah, so the monthly, I had to look. So the actual monthly payment on that mortgage in the example, it's in the description if people read through the description, but it's the principal and interest payment is, let's call it $1,390, right? Just for a round number. $1,390, or that's not right. $3,190.
$3,190.
$3,190. Okay. Yeah, for $600,000 purchase. Yeah. So you're looking at $3,190 as a normal principal and interest payment in that scenario.
Right.
With a 2-1 buy down, right? The equivalent of 2 percentage points lower. So we were running a 6.99. So you'd be looking at a 4.99 payment.
Okay.
So that would mean the seller would have to contribute $750 a month for that first year, and about $382 a month for that second year. Okay. And then we're going to be on.
So for the first year, that borrower is saving $750 per month in their payment.
Right.
Okay. Which I would imagine anybody buying a home, especially if it's their first home and they're coming from a rental and they want to adjust into buying a home where there is that payment shock sometimes. Mm-hmm. People have lower rental payments or they're living with their parents and saving up money to buy something. So it's actually nice to kind of ease themselves into making that full payment where they have some subsidy, from the seller. Right. To make that offer. Okay.
Well, the other thing is $15,000 is a lot. Like maybe for the fees that we charge, right, you're not going to use $15,000 in concessions. So this is one way to use that. Otherwise, you'd be pairing it with normal closing costs plus a temporary buy down. Right. And then it comes into really what's best for their situation. Is the net cash flow on a monthly basis more important, or is it the one-time expense today? Like,
yeah, that's where we have the conversation. Their closing costs as well.
Right.
Yeah, no, that makes sense. That makes a lot of sense. So in this scenario, now let's say I know a lot of people, like you said, they're predicting that the rates will be coming down, mm-hmm. right? That's the general consensus. Anybody that I speak to all shares that very same thought. And, I guess there's some people that say, well, what if they don't? There is a risk for, other borrowers who are doing these adjustable rate mortgages where, they're anticipating that the rates will come down and that they'll just refinance. But what if they don't? Because nobody has a real true crystal ball. We all think that that's where it's going, and likely is that that's where it's going to go. But so in this particular scenario, like if the rates don't go down, like what happens? Nothing. They just pay the payment that they were scheduled to pay, and they're paying off their loan as if it was a 30-year loan, and that's it, mm-hmm. right? Nothing really changes.
Right, so you have the $15,000, right? So you could have the same loan amount, you do a 30-year fix, no temporary buy down. Right. You're making your full payment, the $3,190 the entire time.
Sure.
You do the temporary buy down, you're still making the $3,190, it's just the seller splitting it with you. So the math works out the same, it doesn't matter what year, because it's a 30-year fix.
So now let's look at it from the other perspective, and mm-hmm. let's say that the rates do come down. Let's say they come down a full percentage point or maybe a point and a half, wherever that might land. If you go from 6.99 to maybe 5.5, which could be something that happens maybe in a year or so. That's kind of what people have been predicting, mm-hmm. being into the fives. So let's say, before this 2 years is up, they want to refinance that loan because it makes sense for them to do so. How, do they just lose that money in that buy down, or what happens with that? Is that applied towards refinancing?
So that's part of the popularity of the temporary buy down,
right?
Because if you just do normal closing costs and a permanent buy down, once that money's spent, it's gone.
Right.
The temporary buy down, if you think the market is going to drop, right, you're depleting that extra account mm-hmm. with the seller's funds every month. But if you have the opportunity to refi before that runs out, that money's applied towards paying down your principal. So you don't actually lose it. It's just going to buy down your principal on when you refi. And hopefully you get that lower rate. And then you're going to, by the time you're making your regular payments, it's lower than
So that's good. So it's just sitting in an escrow account, if you will, and being applied towards those payments. And if you decide to refinance prior, mm-hmm. any monies left in that account are applied towards the refinance costs.
Absolutely.
So that's awesome. So they never lose any of that concession that they would have received from a seller.
No.
Right. Okay, good. Now, does this negatively affect a seller's cost in any way? I know there were some comments, and just to put it
You're a better person to answer that one.
So I will, but...
right, I mean...
Do you want to ask me the question?
No, but we saw... No, that's fine, but we saw in the comments, right, that people were doing the math, and they're saying, right. Well, how does this negatively impact the seller? Why would they do this instead of that?
Sure.
So,
when it comes to brokerage fees, that's one component of what a seller's cost is going to be. So, and the brokerage fee is designed or based on what the sales price is. So, in this example, if the borrower or the buyer would have offered $600,000 and didn't ask for any kind of concession, where they're inflating, if you will, the sales price, then they would just be paying a commission on $600,000. So, in this example, the seller would then be paying a commission on a $615,000 sales price, which is going to add to their cost by a little bit. Whatever percentage the brokerage fee was negotiated with the broker and then the seller would be the difference in what they're going to pay in terms of costs. And that's a decision for the seller to make, of course, when it comes to accepting any kind of offer. It's really what their net's going to look like. So whenever I work with a seller, Kyle, and we assess any kind of offer that comes through, we're always looking at the price, the terms, and the conditions, but ultimately what their net is, and really that's what a seller is looking for when they're looking to sell a home. It's, when they come to me and they say, Bill, we want to sell our house. I'm hoping to get this for it. They understand the market is what the market is, but they usually have a dollar amount in their mind that they want to walk away with. So that's our goal. That's what we try to accomplish. And one of the benefits in, working through the numbers like this to make it more advantageous, maybe more affordable for a buyer, particularly in the first few years, is that you can get maybe a better offer from your buyer because they have a little bit of support and assistance. And while you're doing that, believe it or not, your net could be higher. So it's all kind of handled in the negotiations. And, to your point with a borrower, when they look at, what kind of product they want, how they want to use these funds, the same thing happens with a seller when you're negotiating an offer. What's important to you? What's the goal? What do you want to accomplish, right? So we look at every offer, with the idea that the seller has certain goals they want to accomplish and whether or not it makes sense for them to accept or not. But the fees are the fees and they're based on the sales price.
So I think we've all seen a shift in the market, right? If you look back 2 years ago, people were lined up outside of open houses, assuming there was an open house. And then that day they might get 10, 12, 20 offers, and it's multiple offers, and it's a really competitive situation.
Right.
Today's market is not that market. So what I've seen on contracts, and maybe you've seen this as well, is that sellers are willing to come to the table and have that conversation with the buyer that they weren't willing to have a couple of years ago.
Yeah.
Which is
no, you're absolutely right. So and it also, I think it depends, not so much the market has a great influence in all of this, but also the property and how it's positioned. Yeah. Because again, when you're meeting with a seller, like I might position a property to the point where we can get multiple offers. And there's a strategy behind that, which is a completely separate video. But it really depends on the house. And if you're a buyer and you find yourself in a position where there are multiple offers on the house, asking for a concession is probably not going to be a good idea or a good negotiation strategy because it's only going to make your offer look worse than some of the others. Yeah. Right? But yeah, the market is, of course, relative.
And I think one thing that we also need to talk about is motivation. There's motivation on both sides. Buyers want to buy the house for relocation, family adjustments, area, whatever the case might be, but the seller also has the same motivations that they're personally tied to, which could impact what they're willing to give.
Yeah, no, that makes sense. So here's another interesting one. If the sales price is higher as a result of the seller credit, does that mean that the buyer is going to have to pay more in property taxes?
Maybe, but not in Arizona.
Right. So the way that the taxes work here, it's all based on an assessment from the county, and it's not directly related to the sales price of properties, but it's related to the sales price in the given area, and then they'll do their annual assessments, and you'll get a notice, and you can dispute it, you can argue it, or you might be happy with it. Since I've been in Arizona, interestingly enough, as it's related to property taxes, my property taxes have come down 2 years in a row. And that didn't happen in the last state that I came from. So,
right. And that's super important to clarify. We are working in Maricopa County in Arizona, which has its own tax setup. And this video obviously went out nationwide. So check with your local municipality or your agent and see what the difference is.
Your taxes are a percentage of the sales price. Yeah. So that could have an impact depending on where you are. And then I think we kind of discussed this a little bit, but why would a seller want to offer this to a buyer? And isn't it costing them more money in fees in the real estate brokerage? And we kind of addressed that. Yeah. It's really market driven and what makes sense to accomplish their goals. Does it negatively? Yeah. So, that's pretty much the gist of it. And hopefully that clarifies some of the questions that, some of you had. If you have any other questions, by all means, Kyle is awesome.
Yeah. Can I add one more thing? Just to wrap it up?
Sure.
So one thing that I think is very important is there isn't one size fits all.
Right.
Every contract is different. Every buyer is different. Everything is different. So it's about taking the negotiation that's put in place and figuring out what options are available and just letting our clients be able to make an informed decision based on the factors of the contract.
No, that makes a lot of sense. So our goal isn't to make decisions for people.
Right.
We give them their options, and then they choose what's best for them and their family based on their knowledge and what we share with them.
100%.
So, and you are great at explaining those options to buyers. You know, it's fantastic the way that you're able to explain it. So if you have any questions about this product or just even getting a mortgage, what you might be approved for, or buying or selling a home, you know, please feel free to reach out to us. I'll leave your information in the comments below, and I'll have my information down there as well. And for now, good luck house hunting, and I wish you the best.